Greetings, great hope learners. My name is Mr. Simbi, and welcome to today's accounting lesson. I missed you last week, but I do hope that you guys were studying. Now, in today's class, I'm going to be concluding on budgets. You remember in the previous class, I did the cash budgets. I did several calculations which pertain to the cash budget. We did the debtors collection schedule, we did the creditors payment schedule, we did several reverse calculations going forward, going backwards. That is what we did. Please, if you need any assistance in doing your debtors collection schedule or your creditors payment schedule, you should revisit that class. You'll find it on this very same page, and then you will get a lot of help. As I said, in today's class, I'm going to be continuing with my budgets, and I hope to conclude them because next week we're going to meet early in the week as we prepare. You are aware that on Friday we're writing our paper 1, so we need to be ready. We need to assist each other. Here are my objectives in today's class. I'm going to speak again to concepts that relate to budgets. I'll also speak on the projected statement of comprehensive income. And then I'll also do certain budget calculations. And I'll also be doing some analysis and interpretation of information that is given in the budgets. What is this projected statement of comprehensive income? It is a financial document that focuses, so we look ahead, focused at an entity's expected income and expenses for a future period. This is our projected statement of comprehensive income. It's a forward-looking statement used for planning and budgeting purposes. It helps businesses to anticipate financial performance so that they can make informed decisions. So you would find that in the previous class, I did the cash budget, and then in today's class I'm going to do calculations again that pertain to the cash budget, and then I'm going to marry this together with the projected statement of comprehensive income. Now, it is important that we draw the distinction between our projected statement of comprehensive income and the cash budget. Is there a difference between the two? If there's a difference, then you should know this difference, because in the exam, there are questions that do come that will test you on the differences between your projected statement of comprehensive income and the cash budget. So let's look at the differences between the two. The first one, let's look at the purpose. The purpose of the projected statement of comprehensive income is to estimate the profitability of the business over a future period. So we're looking at profitability here. But with the cash budget, we estimate the cash inflows and cash outflows. Remember, with the cash budget, we're looking at the movement of cash. All right. So we estimate our cash inflows and outflows over a future period, ensuring the business can meet its financial obligations. So that is the purpose. Let's move on to the focus. What does the projected statement of comprehensive income focus on? It focuses on income and expenses. Thereby, we then arrive at either profit or loss. So you need to know that when we prepare the projected statement of comprehensive income, our focus is on income and expenses, and we calculate either profit or loss. Unlike the cash budget, because the cash budget focuses on receipts and payments, not income or expenses, but rather receipts and payments. This is what we focus on in the cash budget. We will now look at the accrual versus the cash basis, because the projected statement of comprehensive income is prepared on an accrual basis, recognizing income when it is earned and expenses when incurred. All right, very important. We recognize income when it is earned, not when it is received. when it is earned and an expense when it is incurred, regardless of when cash is received or paid. Very key here. But with a cash budget, it is prepared on a cash basis. That is, only recording actual cash inflows and outflows. So here we look at the movement of cash, not when it was earned or when it was incurred, but actually the movement when it is paid, that is the outflows, or when it is received, that is your inflows. And then we'll also look on what we call non-cash items. That will be the last aspect here. When we look at non-cash items, you'd find that in a projected statement of comprehensive income, you will record non-cash items such as depreciation and your provision. So we're talking provision for bad debts. And then in the cash budget, you exclude non-cash items. You only record cash items. All right? Because here we're looking at the movement of cash. So non-cash items will not be recorded in your cash budget. I think you can remember this even from your grade 11. Okay, so if we are ready, I want us to do a question now that speaks to this. All right, can we have a question that speaks to this information that I have just explained to you? That takes us to activity number 1, which I have adapted from the NSC June the year 2021. Remember, we're in paper 2. All right. It says, insert the relevant amounts for each transaction below into the appropriate columns for the following: cash budget and projected statement of comprehensive income. You can see here it's income statement. Okay. Then we are given an example that monthly telephone costs are expected to be 4,200. When you come here, you know that your telephone costs are 4.2, so you're going to make a payment of 4.2. And that telephone is an expense. So you come to the projected and then you have your 4.2 as well. Let's move on now to the transactions. We are told a 3-month advertising contract for 6,000 will be paid on 1 July 2021. Okay, so let's come now to the answer book. Remember, when you are going to be writing your prelim paper next week, it is very key, very important that when you're given the 10 minutes reading time, that is the first hint that I'm giving you for today, that when you read your question paper, make sure you read it together with the answer book. So you read your question paper and then you see, how does the examiner want me to present this information? So you read your question paper in collaboration together with the answer book, not in isolation. You read them together. Okay. Now, we can see that we are given transaction number 1 and we already have our answer book with us. So it's a 3-month advertising contract for 6,000. Will be paid on the 1st of July. And then 2,000 of this amount relates to the next financial year. So I'm going to come here and I'm going to say, here is my number 1. So that is my number 1 there. And then how much are we going to pay? In July, we will pay 6,000. So I'm going to come here. I'm going to have my 6,000 over here. Then we know that this is advertising, therefore it is an expense. So I'm going to come to the expense. I am then told that 2,000 of this amounts to relates to the next financial year. So it simply means of the 6,000, the 4,000 is for this financial year. That is in the month of July. And then the 2,000 relates to the next financial year. So that simply means if I take my 6,000, which is what we paid, and I know that the 2,000 is for the next financial year, therefore the amount that relates to now is the 4,000. So I'm going to come here and my expense is 4,000. As simple as that. Okay, I'm going to go on to the second one. Let's do that. The second one. On the second one, it says, on 1 July, 45,000 will be invested in a fixed deposit at 8% per annum. Interest is not capitalized and is received at the end of each month. So let's begin first with the 45,000 that will be invested. That means I'm going to come now to my payments and I'm going to say 45,000. The next question is, if we make an investment, is that an expense? Certainly not. So I'm just going to record the 45,000 in the payments and then that's it. But we know that on this investment, we are going to receive interest. And we're told that the investment is 45,000 and the interest rate is 8%. And we are getting it for the month times 1/12. All right. Can I see your calculators, please? Can I see your calculators? How much do you get here? It is going to be 300. So we get our 300 here. So I'm going to come here. Then I'll say my receipt is 300 here. My receipt, I'm going to receive 300 of interest. And then once I have income, I know that it is also income. Once I have interest, rather, I know it is income. So I'm going to come here and I'm going to say 300 here. And nothing gets recorded on the expense. Let's come to number 3. It says, budgeted cash sales of 23,200. Cost of sales is 16,000. So I'll come here to number 3 and I'll say my budgeted sales is 23,200. So that is my receipts. All right. So we're going to get receipts of 23,200. We know that once we make sales, that is income. So I'm going to come to my income, 23,200. And then my cost of sales is 16,000. That now comes to my projected, and I'm going to have my 16,000 as an expense. Under the payment, we do not record anything. That is how we conclude this activity. All right, so we're going to go for a quick 2-minute break. 2-minute break, and then we're going to resume with activity 2. So we're going to take a 2-minute break. See you after 2 minutes. Welcome back. And then we're going to begin activity 2 together. Let's go. Activity 2 reads as follows. Smashers panel beaters. You are provided with information relating to Super Smashers panel beaters for the budget period 1 August 2023 to 30 September 2023. The business is owned by Sparky Bright. The financial year ends on 30 September each year. Now, the business operates on a strict cash basis. The nature of the business, it is to repair damages on the body of vehicles to earn service fee income, sell spare parts used to repair, and to over-the-counter customers. Other consumables used during repair services are recorded as service fee expenses. These costs are charged thereafter to clients' accounts. And we're required to do the following. All right. And then let's come here, and here is more information. All right. And this is the projected statement of comprehensive income. All right. And then here's question number 1. Question number 1 says, calculate the markup percentage maintained for the sale of spare parts. The markup percentage, there is the information. So we want to calculate the markup percentage. Markup percentage. We know that if we're to calculate markup, we would say it is our gross profit over our cost of sales. Multiply this by 100 over 1. That is what gives us our markup percentage. So we want to calculate the markup that is maintained. Let's come to the month of August and see what happened in August. In August, the profit on the sale is 34. So we're going to say, remember, for you to get the profit, you simply say sales minus cost of sales. That's your gross profit. So we're going to say it is my 34,350. I divide that by my cost of sales. And my cost of sales is 45,800. And we multiply this by 100 over 1. Let's see if we can find my calculator. There it is. So we're now going to say it is my 34,350. 34,350. And we divide this by 45,800. All right. And then we multiply this by 100. So we're getting 75%. So here we're told it is 75%. That is what we find in August. That is what we find in August. Let's see if we come to the month of September. If we come to the month of September. If we come to the month of September, we will still say our profit, which is 50,625. I divide that by my cost of sales, which is 67,500. Remember to say multiply by 100 over 1. How much do you get on your calculator? It's your turn to punch in now. Thank you. 75% as well. Okay, so that is the markup percentage that is maintained. Very key that the examiner can ask you to calculate particular, like here we are calculating the markup percentage. So you have to be able to know how to calculate some of these figures. Are we together? Like here, they wanted us to check the markup percentage that is maintained for the sale of spare parts. I'm going to move on to the next aspect. Okay, it says, calculate the percentage decrease in service fee income expected in September. So when we come to service fee income, which is this one here, you can see that in August it is 224,000. However, it declines, it decreases in September, and it becomes 203,840. It has decreased. We know it has decreased. Now, the examiner wants us to calculate the percentage decrease. By what percent did it decrease by? That's not much of a challenge, isn't it? We know that you take your August amount, that is your old amount, and you say your 224 your old amount, 224,000, minus your 203, your new amount, 203,840. Let's see how much you're going to get. Punch that in your calculators. How much you're going to get? 20,160. Then you divide that by the old amount, which is your 224,000. So you divide this by your 224,000. You multiply by 100 over 1. How much do you get on your calculator? Okay, let's do that together. So we are saying 20,160. 20,160. We divide that by 224,000. And then that's going to give us, all right, we multiply by 100. That's going to give us 9%. So we end up here with 9%. That becomes the percentage decrease in the service fee income. Okay, let's move on to the next one. The next one is number 3, and it reads, calculate the additional space in square meters which the business plans to rent from September. We can see here our rent is 9,000 in August. In September, the rent is now 13.8. Okay. Oh, we can see that now there is information that we're given. Let's read it together and listen. Rent expense is calculated on a fixed amount per square meter. The business currently rents 75 square meters. So of this 9,000 that we are paying, we are aware that this is for 75 square meters. So we would want to know how much is it per square meter. That is 9,000. We divide that by 75. That's going to give us 120 rands. That means it costs us 120 rands per square meter. Okay? On the 1st of September, additional floor space will be rented out. They don't tell us how many square meters. At the same rate due to expansion. And then now they want us to calculate the additional space that we took. So if we come to the 13,800 that we are now paying, okay, we are now paying 13,800. Yet we know that if this is 13,800 that we're paying, we pay 120 rands per square meter. So we'll come here and we'll divide this by 120 rands, which is the price per square meter. We want to know how many square meters do we now occupy. So we'll come here, then we'll now say our 13,800. We divide that by 120. That is going to give us 115. That means now we are currently occupying 115 square meters. So if we are now occupying 115 square meters, yet we were occupying 75 square meters, how many new square meters have we added? So you simply get the difference there. Okay, you get the difference. I think it will give you how many? 40 square meters. That is the additional space that we have added on due to expansion. Are we good? Can I move on? Let's do that. Let's do that. Okay, let's move on to the next aspect. It says, calculate the interest rate on the fixed deposit. Oh, I like this kind of questions. You must expose yourself to this kind of questions. All right. In this case, they want us to calculate the interest rate on the fixed deposit. Note that the interest rate is expected to remain constant over the budget period. All right. Now, let's see if we're given any other information. We're told that a fixed deposit of 675,000 will mature. What does that mean? Remember, when we invest in a fixed deposit, when it gets to a particular time, that investment will mature, so it will cease to be an investment. And therefore, we will no longer receive interest on it because it is no longer an investment. So it means in August, we had an investment, which we had. And in September, a part of that investment has matured. Hence, our interest has declined decreased. Our interest has decreased. It is because we have a fixed deposit that has matured. Now, we are required to calculate the interest rate on the fixed deposit. What we understand is that the change in interest is because the fixed deposit has matured. So we want to see how much was that change per month. How much was the change per month in the interest on fixed deposit? We were getting 8,550. And then now we only get 4,050. That means we no longer get how much on your calculator? We no longer get 4,500. This is the interest that we are no longer getting because 675,000 has matured. So the fact that 675,000 has matured means we will lose interest of 4,500 per month. Now, if I take my 4,500, which is per month, I want to know if this was annually, how much was the interest going to be? So I'll come here, then I'll say the 4.5, and I'll multiply that by 12. That would have been 54,000. That would have been 54,000. Then I divide that interest now by my fixed deposit that is matured, which is my 675,000. I divide that by 675,000, and then the answer I'm going to multiply by 100 over 1. So I'm going to now say the 54,000, let's divide it by 675,000. Okay, and then we multiply this by 100. That will give us 8%. It therefore means that the interest rate that we were getting on the fixed deposit was 8%. Okay, this is how you would calculate the interest rate on the fixed deposit. Very important. The examiner can ask you this on the loan. Okay, so the examiner can ask you this on the loan. It's very possible. What if the examiner brings this on a fixed asset? It will still be the same. All right. Remember, here we are in the projected statement of comprehensive income. If you're given depreciation for 1 month, depreciation for the other month, and then they say what was the depreciation rate, it's very possible. So you need to expose yourself to such calculations. All right. Can I move on to the next one then? I'll do that. All right. So that brings us now to activity number 3. Activity number 3. Okay. So after this activity, we're going to take a 5-minute break and then we resume after that. Activity number 3. And activity number 3, here is the information we're given. It says, the information relates to Sunday Stores Pty Limited. The business is owned by Adam Stevens. Refer to information B. Identify, this is your information B now. Identify 2 items that were incorrectly recorded in the cash budget. 2 items that were incorrectly recorded in the cash budget. Let's go and find out. Number 1, is cash sales in the right place? Yes. Cash from debtors? Yes. Interest on savings? Yes. Interest on fixed deposit? Yes. Discount received? No. This one. So number 1 is going to be discount received. Number 1 is discount received. Let's go to number 2. Payments to creditors, it must be here. Salaries of the salespeople, it must be here. Rent expense, it is correct. Delivery expense, correct. Maintenance of vehicles, correct. Audit fees, correct. Bad debts, no. A non-cash item. So I'll come here and I'm going to say bad debts. Number 3. Okay, let me bring my number 3 here. Number 3, then they say depreciation, no. Non-cash item. So here is depreciation. Okay, so I've answered that. 2 items that were incorrectly recorded in the cash budget. Can I move on to the next one? Let's do that. It says again, identify 2 items in the cash budget that would not appear in a projected statement of comprehensive income. 2 items that are in this cash budget that would not appear in a projected statement of comprehensive income. All right, so that one I think is going to be easy for us to do. Let's see. Cash sales, it's going to appear. Cash from debtors, that one. So we're going to have number 1. It is cash from debtors. Cash from debtors. Number 2, I'm going to skip and then I'm going to come now. This one would appear, this one would appear, that one would appear. Then I come to my payments. Payments to creditors. We don't have that one in the projected statement of comprehensive income. So it's going to be payments to creditors. So it becomes payments to creditors. So I have my 2. They say 2. I got 2. We're sorted. Dear learners, we're going to take a 5-minute break and I'll see you after the short break. Welcome back, dear learners, from the ad break. We have done so far 3 activities, and we're now going to move on to activity number 4. Let's begin. Here's activity number 4 from the NSC June 2021 paper 2. Okay, so here it says, Anoki Pty Ltd. The business sells electrical appliances. The financial year ends on 30 April. Kyla Bester is the sole shareholder and CEO of the business. Required. Calculate the amounts for A to D in the cash budget. So this is the information that we're provided with, and what we need to do is to check if this information that we're also given, there it is, additional information. Therefore, we can start our calculations. Let's begin with A, which is what we see over here. And the information reads, rent income is expected to increase by 9% per annum from 1 July 2021. Okay, so there is a number of ways in which one could have done this. The first way was to say your 15,500. Then you calculate 9% of that. Okay, you get 9% of the 15.5. So we say 15.5, then we get 9%. That will give you 1,395. 1,395. Then you now say your 15,500 plus the 1,395. Then you tell me how much you get on your calculator plus your 15,500. That will give you your 16,895. 16,895. That was the other way that you could get A with. The other way that you could have used to get A was to say your 15,500, multiply this. You know that your 15.5 is before the increase. That means it is 100%. But it is going to increase by 9%. So you add 9. That means in July, you're no longer going to get 100. You're going to get 109%. So what you want is 109. But what you have is 100. And then how much is that going to give you on your calculator now? So you are saying what you want is 109. That is what you want. But what you have is 100. And then you multiply this by 15.5. That will give you 16,895. 16,895. Okay, so these are the two options that you could have used. But remember, in the exam, you only use one method because you don't have time. You need to be fast, you need to be efficient, you need to be able to finish the paper. In order for you to do that, you must then choose one method which works better for you. Can I move on to the next one? Let's go and see if we can calculate B. Let's go to B. Jane Investments. The business has negotiated a loan which will be received on the 1st of June 2021. Interest at 13.5% per annum is payable at the end of each month commencing. So here we want to see how much was the loan that we received. How much was the loan that we received? So we know that what we want is the loan. And that loan multiplied by the interest rate of 13.5%, multiply that by 1 month, that will give us the 3,150. That is how we get this 3,150 over here. Okay? Now, once we are here, it becomes easy, therefore, to get this loan that we want here. Remember, we want the loan. That is what we want. Together, therefore, the simplest way is to say your 3,150, you multiply that by this 12 over here, you multiply that by 12. Let's see how much that's going to give you. So you say 3,150. Multiply that by 12. That is going to give you 37,800. So you end up with 37,800. Then you now say that 37,800, you divide it by 13.5 divided by 100. That is 0.135. You divide it by this one here. That is 0.135. So you come here and you now say your 37,800 divided by 0.135. And then that will give you 280. So it gives you 280. That then becomes your B, the loan that you would have received in the month of June. Are we okay? Okay. Can I move on to the next aspect then? Let's go on to calculate C. Let's see if we can calculate C. Here is C. Here's the information we're told. The business employed 5 sales assistants in May and June on the same salary scale. And then 3 of them, okay. So, but before we jump to the next one, let's see. So we have 5 sales assistants. And in total, they're getting how much? 41,000. So it simply means if I take my 41,000, if I take my 41,000 and I divide it by my 5 sales assistants, that is going to give me how much per sales assistant. That is my 45,000. Okay, 41 rather, 41. It is 41,000. And I divide it now by 5. Then I divide it by my 5 sales assistants. That means each sales assistant is getting 8,200. Each one is getting 8,200. Okay, so it means this one here is going to get 8.2. And that one there is going to get 8.2. Remember, that's the second one. The third one is going to get 8.2. The fourth one is going to get 8.2. And here's the fifth one, getting 8.2. This is what they say here. 3 of them will receive an annual bonus of 75%. So it means we're coming here to say of the 8.2, they will get a bonus of 75%. Multiply by 75%. Let's get that bonus. How much is that bonus? We're saying 8.2 multiplied by 75%. That bonus is 6,150. So the bonus is 6,150. So I'm going to come here and I'm going to say plus 6,150. How many are getting? They say here 3 of them plus 6,150 plus 6,150. That is for the 3 of them. Then they go on to say, a part-time sales assistant will be employed during July. So we are coming and we employ now the part-time sales assistant. And that part-time sales assistant will earn 50%. That means of what we are giving others, which is the 8.2. This part-time sales assistant is going to get 50%. That is 4,100. So this part-time sales assistant is going to get 4,100. And then that is it. So what we're going to do, we're going to add everything here now. You do that for me. How much are you going to get? If you now say your 8.2 plus 6,150, I think that's going to give you 14,350. And then the other one is 14,350. And then again it's 14,350. 350. Then the 8.2 remains, and the other 8.2 remains, and the 4,100 remains. And then the total of this one should give you an amount. How much is that going to give you? That is the total now. 63,550. 63,550. 63,550. But remember, this was a longer way. I wanted you guys to understand what we were doing. This was the longer way. The shortest way would therefore be to say, the shortest way would therefore be to simply say, the 5 are going to maintain their 41,000. So it will be to say the 41,000, they're still going to get that. Then you say plus 3 of them are going to get bonuses, which is 75%. So you're going to say plus 41,000 times 75%. All right. And then I think that gives you 18,450. All right. Then you get that one. And then that is the bonus. But remember, that is for 3 of them. That is for 3 of them. All right. So let me come back to that one. Let me do it the right way. That is for the 3 of them. So let me rather say 8.2. Let me rather say 8.2 times 75. Okay, so it gives you that 6,150 that we had earlier on. It gives you the 6,150. Then you multiply that by 3. That's how it gives you the 18,450. 18,450. Then you simply add now for the new part-time assistant who's getting 4.1. Then it would still give you your 63,550. Okay, I know I took time here. I just wanted you to understand how this adjustment can be done. So you can do it this way here, or you can do it the faster way, which is this one here. I know there's even a faster way as well, apart from this one. Okay, can I move on to the next one then? Let's come on to D. Let's get D. When we get D, we will now say, iterate the information. Kyla earns director's fees of 720,000 for the year. The company also employed another director, Martin. Okay, so let's start with Kyla. Here's Kyla. Kyla is earning. This is Kyla. All right. So Kyla here is earning 720,000 for the year. So we say 720,000 for the year. We divide that by 12. That means Kyla is getting how much per month? 60,000 is what Kyla is earning per month. And then we're told the company has also employed another director, Martin. So there is Martin. And Martin, for the entire year, Martin will receive an increase of 8%. So when we come to June here, Martin has already received his increase. So if we want to know how much Martin is getting, we should know that Kyla plus Martin is equal to 98,880. Is equal to 98,880. That is what becomes the total. So if we want to get Martin's salary, we'll simply say 98,880 minus the 60. That will give you 38,880. That is what Martin is getting. But that is after an increase of 8%. Now, if Martin is going to get an increase of 8% and the amount is 38,880, we want to know how much it was in May. So it means I know that my 38,880 is not 100%. It is after the 8%. So this is equal to 108%. But what I want is the 100% before, because we want for May here, before the increase. I want the 100. But what I have been given is after, which is 108. Multiply that by 38,880. And then we punch that in our calculators. How much do we get? We get how much? 36,000. So we get 36,000 here. It therefore means in the month of May, Martin was not getting 38 because it only increases in June. In the month of May, Martin was getting 36,000. This is what Martin was getting in the month of May. So if I take what Kyla is earning, which is 60,000, remember it has not changed for Kayla. So it will be the 60,000 for Kayla, which has not changed, plus the 36,000 for Martin, which increases in June. That will give me now my 90. I think the amount becomes 96,000 here. 96,000. That is my D. That is the director's fees for the month of May. Okay, so here we're simply calculating going back. Okay, I'm going to come to the next aspect now because we have done a couple of calculations. Now we want to begin to analyze, look at information, and what does that mean? So it brings us to an aspect called variance. Okay, when we look at differences between what has been budgeted and what actually happened. So you will see here, I'm going to now introduce you to variance analysis. Variance analysis is the process of evaluating the differences between planned, that is the budgeted financial performance, and the actual financial performance. So there's two things that you look at. There is the budgeted and there is the actual performance. So variance analysis involves identifying and understanding the reasons for these differences to help businesses manage their finances more effectively. Now, how do we analyze and interpret when we are in budgets? You have to understand that when the examiner wants you to do that, they will give you a table of information where you have your budgeted here and you have your actual here. I'm going to do that with you so that you can understand. Management will use the existing information to monitor and control the business operations. This process involves the comparison or the comparing of budgeted figures and the actual figures. The difference between budgeted and actual will be referred to as variance. Okay, and therefore a company will do a variance analysis report. Okay, then I'm going to now come on to the negative and the positive variance. Okay, so positive variance, this is better than what we had anticipated, and the negative variance, this is worse than what we had budgeted. Let's look at an expense. In your mind, just think maybe rent expense. Let's think rent expense. Okay, or you can think another expense such as delivery, or you can think advertising, you can think stationery, you can think a number of expenses. All right, let me also bring here another expense, maybe your another simple expense, your telephone. You can also look at such expenses. I'm going to bring telephone here. All right, a positive variance happens when the actual expense are less than the budgeted. That is a positive variance, when the actual is less than the budgeted. And then a negative variance happens when the actual is more than the budgeted. That is your expense. A negative is when the actual is actually more than the budgeted. With income now, think your commission income, think your rent income. All right. So a positive variance is when the actual figures, the actual income that you receive is now more than the budgeted. Therefore, it is a positive variance. Yet a negative variance is when the actual is less than what we had budgeted. That therefore would be considered a negative variance. I've seen in some exam papers whereby the examiner would want the learner to indicate if it's a positive or a negative variance. So this is not something that you would want to take for granted. You need to know and you need to prepare adequately. So I'm going to come to my next activity, which is activity number 5. With activity number 5, it reads, Kayla extracted the following actual and budgeted figures. Okay. And then for May. So we have budgeted and we have actual. Now, we are required to comment and quote figures on the effectiveness of advertising, and we need to quote figures in each case. The effectiveness of advertising. It is very important that even before we get into this, what is the main idea of advertising? I've heard a statement that says big businesses are big because they advertise. In other words, if we are advertising, we're doing it because we want to attract new customers. We want to be big. That means when we advertise, we would expect to see a relationship between our advertising and our sales. Therefore, if we advertise more, we should see more sales. All right. Now here we want to see if our advertising is effective. You will see here that there is a decrease in our advertising. No, rather it is constant on advertising. I was looking at delivery. Our advertising is constant. Our advertising is constant. That is 35 to 80 and 35 to 80. So it is constant. All right. Now, even though our advertising has remained the same, you can then see that our sales here, remember, these have to be related, they have to be paired. Your advertising has to speak to your sales. When you look at your sales, you must be able to talk to your advertising as well. If our advertising has remained constant, we would then have expected that our sales would have remained constant. But in this case, you can see that our sales have declined from 882 to 705,600. So we would therefore say, although on our advertising, the amount is the same, that is, there is no change from the 35,280 that we had budgeted to the actual. There is, however, a decline in sales from 882 to 705,600, that is 176,400. And if we are to make sense after this, we have to calculate a percentage to say the difference between the 882 and the 705. We would say 882 and 705, that is the 176.4. So we then say the 176.4, then we divide that by what was budgeted, which is the 882,000. I multiply this by 100 over 1. That would give me 20%. So, my advertising has remained constant at 35,280. Yet, my sales have declined by 20%. Does that make my advertising effective? Certainly not. Because there has to be a direct relationship between my advertising and my sales. If my advertising remained constant, my sales should have as well remained constant. But in this case, my sales have declined. So I would therefore say my advertising is not effective. You have to be able to look at this information critically and then comment in the way that I've done. To say, although the amount is the same, there is no change, it has remained constant at 35 to 80 as it was budgeted. The actual sales have declined from the budgeted by 176,400. That is 20%. I want to encourage you, by any chance, if you are able to put the rand value, push yourself further and do the percentage as well. Very, very important that after you've done the rand value, I know you can punch that on the calculator, then calculate the percentage decline as well. We good? All right, let's move on to the next aspect. The next one then is here. Let's see what it says. Comment and quote figures on the control over delivery expenses. The control over delivery expenses. All right. So remember earlier on, I had touched delivery expenses when it was supposed to be advertising. Now let's do delivery expenses properly. Here is our delivery, 57,330. That is what we had budgeted. And you can see it has gone down by 51,200. In your mind, you would think, since my expenses declined, that means I'm controlling my delivery expenses well. It may seem that way, but you need to critically get into it, calculate, and see when you use figures, what do you get? Okay, let's get into it. The first one. The delivery expenses is lower than the budgeted by. So you can see here is my budgeted, which is the 57. And the actual is that one. So we can say my delivery expenses are lower than my budgeted. And to get the percentage, I'll simply say my 6,130. My 6,130. And then I divide that by the budgeted, which is my 57,330. I multiply this by 100 over 1. That will give me my 10.7%, which I'll use here now. So remember what I encouraged you earlier on. You can put the rent value, but I know you can calculate the percentage. Include the percentage as well. So you would say delivery expenses is lower than the budgeted by 6,130 or by 10.7%. All right. Now, it therefore would force us to look at the change that has happened in sales. We can see that our delivery has declined from the budgeted to actual by 10%. But what was the decline in our sales? Remember, we touched it earlier on. Let's look at the change in our sales. Remember, we calculated this 20% earlier on. So, even though delivery has declined by 10.7 from the budgeted to the actual, delivery is lower than the budgeted by 10.7%. Our sales were less than the expected by 20%. So you can see here, if you were thinking that we are controlling our delivery expenses as well, that is not the case. Because if delivery costs have declined by 10%, we would have expected that our sales should have declined by 10.7% as well. It had to be proportional. You can't have sales declining by a huge percentage and your delivery just decrease slightly. It cannot be so. In other words, if our delivery had declined by 20%, then we would have said there is control because there is a proportional decrease in the delivery, which is the same that happened in the sales. But in this case, that is not so. We can see that my delivery has declined or it is lower by 10.7%, yet my sales is lower by 20%. Okay. Therefore, I can conclude that delivery expenses are not well controlled. Here is a hint. Whenever you are given sales, it might not be sales. It might be income from hotel fees that we're getting. It might be a service repair business. Whatever business that we are doing, it might be an internet cafe. Whatever business the examiner will bring us, there has to be an expense that is incurred to generate that profit. So you need to be able to relate these things and say, if my sales have increased or decreased, what has happened to the other expense? And there must be a relationship. It must move in pairs. It must be related. Remember, we spoke advertising. It came together with what? Sales. Now we're speaking delivery. It is also going with sales. So these have to be related. So as you comment in your paper too, you have to look for that relationship. When you're reading during the reading time, make sure you understand the relationship that is given by the examiner. Okay, I'm going to move on now to the next question, which then says, Kyla decided that the business would purchase a delivery vehicle on the 1st of June. State two benefits of this decision. All right. And apart from other items related in the cash budget, list 4 items that Kyla should include in the budget. All right, so let's look at that one first. The business, two benefits of Kyla purchasing a vehicle. The business will own an asset that will lead to an increase in the value of the assets, and then deliveries can be made at the convenience of the business. All right, that means deliveries are now under the control of the business. There is a possibility of the business saving because making own deliveries is more economical because we cut out the middleman. That is, we don't have to pay a high amount because there's no profit anymore that is being made on the deliveries. That can be used to generate other income by outsourcing the vehicle. All right, so that is very key that we also consider that one. I'm going to move on now to my next activity. That is activity number 6, which will be the last activity for today. Activity number 6. Okay, let's look at it. And it says, refer to information G, budgeted and actual figures. In order to increase sales, Adam decided to change the way in which salespeople are paid each month from the month of November. The salespeople agreed to the change. Explain the change that Adam made. Let's look at the information. All right, so this was the budgeted, and this is the actual. When we talk about change, it simply means there's something new, something new. So if we look at the budgeted and the actual, what is the new thing that we see in the actual that was never in the budgeted? That speaks to change. That speaks to change. So if we come to actual, we'll see that there is now commission for the salespeople. Yet here there was salaries. You can see there's now a huge change here. There's a huge change. Okay. So Adam introduced a commission to the sales staff. He's now paying them on commission. Decided on a smaller or reduced fixed salary. So he has reduced the salary to a smaller amount and then is now introduced a new system to pay them on commission. That is what we can see here. That is the change that we can easily pick up on what Adam has decided. Okay, let's go on to the next aspect then. And then the next aspect, we are then asked here, explain why some of the salespeople regretted their decision to agree to these changes. Quote figures or show calculations. So after agreeing to these changes, some of the salespeople then regretted their decision. Now they want us to quote figures and show calculations in why these salespeople regretted. Now, you have to know that the examiner can bring this kind of questions in any direction. So you must be able to think and look at the information and look at the changes that have come about this new decision that Adam has made. For example, if you look at what was budgeted, the salaries of the salespeople was what? 165,000 here. But now, after the change, which is the reduced amount, which is 20 and the 141, if you add these ones, I think it will give you 161,050. Is that correct? Okay. So that simply means the reason why they would regret is that the fixed salary plus the commission is 161,50. You remember this one here is less than the 165 which they earned previously. So they were earning 165,000 previously, but now it is reduced 161,050. That is a cause for regretting. This is 3,950 less than the previous month. So they're now getting less than the previous month. That would cause them to regret. Now, the second thing that you would also want to think about is what has happened to total sales. You can see here, since they're now earning on commission, these employees are putting more effort because you are getting paid based on your performance. You're getting paid based on your performance. So I can imagine that these employees are working so hard now. And you can see that in the sales have increased, your total sales have increased there. But their income has actually decreased. So the second point why these employees would feel that no, we did not make a good decision, why they are regretting, is their contribution to sales is the 325,500, which is 30% above the budgeted. All right, so we are here, these amounts. Remember that budgeted 1,085,000, but the actual is 1,410,000. Yet they're earning less. So they have contributed to an increase in sales, yet their income has actually decreased. That is why they are regretting on this new change. And then thirdly, if you look at the number of customers, before the change, there were 480 customers that were attracted on average. But now they have brought in more customers. If you get the difference between your 480 and your 640, you'd see that they have brought in 160 more customers. That is 33 and a third percent. So if they have brought in more customers, yet they are receiving less income, that is a cause to regret. All right. Someone is saying, Mr. Simbi, please show us how to get the 33 and a third percent. You would simply say your number of customers that you are attracting now is 640 minus the number of customers you were budgeting to attract, which is 480. Then the difference is the 160. Remember this 160 here. Then you divide the 160 by the 480. You multiply by 100 over 1. That is what gives you 33 and a third percent. 33 and a third percent. Okay, can I move on now to the next aspect? All right, so before I move on to the next aspect, we're going to quickly take exactly 1 minute break, and I'm going to see you in exactly 1 minute. All right, I'll see you in exactly 1 minute.
Excellence. Excellence is a habit. Excellence is a quality you have, a quality I have. It's a quality we have when we honor what is true to us. Yes, we are gifted differently. uNkulunkulu akasinikanga ngokufana. Excellence is striving for your best. Whenever you have a particular project, test, homework, uzibuze, ask yourself, is this my best? Can I put in more effort? Excellence is striving to be in the top 1% of the area in which you are gifted. And so I challenge you, in every single thing that you do, in every single area that you're gifted in, whether it's sports, it's academic, ucula, whatever that gift is, strive for excellence.
Welcome back, dear learners. We're on the last few slides and then we're going to call it a day. All right, so we're done here. Let's move on to the next question. And then it says, Adam is concerned about the escalating rent expense and plans to purchase the property. Calculate the net effect of this purchase on the receipts and payments in the cash budget. Okay, and then Adam plans to finance the purchase of the property by acquiring a loan and using the fixed deposit that matures. So, by acquiring a loan and using the fixed deposit that matures. So, here is the cost of the property that he intends on acquiring, that is 2.5 million. So far, this is the extract from the projected statement of comprehensive income. And this is the extract from the cash budget. What they want us to do is to calculate the net effect of this purchase on the receipts and payments in the cash budget. Now, if he is going to purchase this property, we know it's going to cost 2.5 million. All right. So the first thing is that he's going to receive some money, that is the fixed deposit. So he's going to receive 1 million. So we're going to come here, then we're going to say he's going to receive 1 million. That is from the fixed deposit, as we're told here. And he's going to get a new loan, as we're told here. He's going to get again a new loan that is for 1.5 million. Then after that, he can be able to buy the property. And remember, the property is how much? 2.5 million. That is the cost of the property, 2.5 million. Now, once he has bought this property, you have to know that the moment he gets this loan, he is now going to be paying interest that needs to be considered. That means we're going to come and say minus 18,750 because we now have interest which we are going to be paying now. So it's a minus 18,750, which is this one. And since he has a new property, he is going to be paying monthly maintenance, rates, and insurance. So that's another aspect to consider. So I'm going to come here and I'm going to say minus 12,500 as well. That is for the monthly rates and insurance. And then, since he is not reinvesting this fixed deposit, he's not reinvesting the fixed deposit, that means from his receipts, we will no longer be getting 7,500. That means from our receipts, we're going to be less 7,500. From our receipts, we're going to be less 7,500. And then the one thing that is going to be an advantage for him is that he's no longer going to be paying this rent expense of 31,640. That means that money is going to be used now favorably. So we have more income here, that is 31,640, because we will not have to consider the rent anymore. Now, if you punch this on your calculator, you get a net effect of 7,000, a negative 7,110. This is what the examiner wanted us to calculate. Looking at the effect of this decision, all right? So we looked at the amount of fixed deposit that is going to receive, and then we add the loan that is going to receive as well. So this is the fixed deposit plus the loan. Then that money is going to be used to purchase the property. But we know that on the loan, we're going to be paying interest, and we need to pay for monthly maintenance rates and insurance. And we know the moment we use the money from the fixed deposit to pay for the property, we are going to forego or lose the interest on the fixed deposit. So that's a negative as well. But we know that once we have a property, we don't have to pay rent So that's a positive. So we're going to end up with a negative 7,110. That becomes the net effect on the purchase of the property. Then the last one is give one reason why Adam has decided to go ahead with this purchase. When we acquire an asset, it brings about capital growth. And then the business acquires a fixed assets, which is good for the business. And then that brings about long-term stability of the business. And then the sustainability, that is, the future is secure. And then we get to save on the ever-increasing rent expense. My dear learners, we've come to the end of today's lesson. But here's what I promise you. During the week, we're going to have a lesson before we write our prelim exam. I'm going to come here with the paper 1 final revision. I hope to see you this week. Make sure you ask your teacher when is the revision coming. And there's a worksheet that we're also going to give so that our online class becomes effective. Please make me a promise that I'm going to see you when the online class is going to happen. It is most likely to be on Thursday, but please confirm with the teacher when the online class is going to be, as we do the final revision before we write our paper 1. I want you to promise me that this entire weekend you're going to sit down, study. Once you apply yourself, once you commit, once you give yourself to your studies, you will definitely reap favorable results. I know you can do it. I know you have been working hard, and it's only a few days left now. So I want you to continue, and you get what you deserve. Until next time, enjoy your studies. Goodbye.